everyone. Welcome back to the Midnight Markets podcast. My name is Sophia, and we have a really special guest, Professor Robert Van Order. Thanks for being with us today.
Thank you for asking me.
Yeah, and can you tell us more about yourself? I mean, you're my professor for my capital markets class, but a lot of people don't know you, and I wish they knew you because you know so much.
My history in research and work has been in mortgage markets and financial institutions. So I was chief economist at Freddie Mac, which is a major mortgage institution, for about 15 years. And I've been professor at GW for about 15 years as well. So my field is mortgage markets. It's also related to real estate. And one of the things my co-author and I do in the book that you're going to advertise for me is look at house prices in the two countries and how they moved over time and how different they were.
Yes, because since the very beginning of markets, China has been also really, really important in the US. They've been literally the greatest, right? And like in powerhouses.
Oh,
yeah.
Sure. I mean, the United States is still the powerhouse economy.
Yeah.
China is close to, in terms of GDP, to the same size, but they have about 4 times as many people.
Yeah, the population is making them big powerhouse they are, right?
Well, has made. The population isn't growing there to speak of.
Oh, yeah, that is interesting. Have you ever been there?
Yeah.
Yes.
So my co-author's Chinese. I've been there and I've been to conferences and
Oh,
things like that.
So can you tell us more what you did in your time working at Freddie Mac?
Well, I was chief economist. I came there in 1987. The day I accepted the offer was the day the stock market crashed. Which didn't affect me, but I thought it was sort of interesting. And it was also right around the time that Alan Greenspan resigned as head of the Fed. So I got there in 1987, did research. One of the things I liked about Freddie Mac was we had a good research group. And actually our research got used in many Wall Street and financial institutions. The research isn't as strongly related to the company, but we were in there and we had a lot to do with pricing and capital requirements, and we even had publications in serious journals.
That's amazing, and you were part of it all since the very beginning.
Well, it wasn't the beginning of the company, and there were good people before me, but that's when I was there.
Yeah, and did you ever know what your work was being used for later with other firms?
No, the only firm I've worked for is GW. I visited some other ones. That's the only one I visited since I was there. So I never really thought of going to Wall Street or some related firm. A lot of people did. There were a lot of startups that were involved with Fannie and Freddie, but I liked being chief economist and I liked being a professor.
And when you were doing economics, did you ever look at specific trends while you were working there?
At Freddie Mac?
Yeah.
Yeah, that was a big part of my job. I mean, I did research, but chief economists are supposed to be oracles. And so I did talk about the industry and what was going to happen, and that was part of the job.
Okay. Did you ever specifically did you ever think of it as I look through the CPI or specific indices, or did you ever just look through other things like tips or something?
Well, I did look at tips, and I've looked at tips, and the reason I like tips, these are indexed government securities, so they're just like regular bonds, except the payments are indexed to inflation. And that's interesting, if only because there are the same sorts of securities issued by the Treasury, the same term and everything else, but where payments aren't indexed to inflation. And so you can think of the rate on regular treasuries minus the rate on the tips as what the market is expecting inflation to be. And that's kind of interesting right now because it's volatile. And so I look at that. I look at that one. At Freddie, it had something to do with interest rates. I looked at that and talked about that, and indeed about house prices, which I was consistently wrong about.
So would you ever do like lots of statistics or just like?
Well, I am to some extent a data hound, but not very much.
Mm-hmm.
So I would use data to keep up on what was going on. I and colleagues did research, and for that we used, for instance, Freddie Mac data. We had access to a lot of data on defaults, and we spent a lot of time looking at what determined defaults, which was the research part. The chief economist part was talking out loud and knowing about the numbers and having some insight into where they were going.
Yes. And who would you use to present these numbers to?
Well, at Freddie Mac, the administration was interested in that. It wasn't the main thing they were interested in. They were interested in what was going on with interest rates, and we did talk about that. Usually, we didn't have our own forecasting model. We just used what traders suggested from their trades, just like they suggest right now that inflation is expected to be around 2.5% because the spread between one type of treasury and another suggests that.
Okay. Yeah, so it's always been like it's always been calculated like this, right? The difference.
Well, tips aren't that old. They really didn't start until 2007 or so.
Okay.
So I didn't have that when I was at Freddie Mac. We did have the yield curve, which gives some indication of what the market expects rates to do. And we would use that if only not because it was particularly accurate going out. Nothing's particularly accurate in terms of forecasting interest rates 10 years from now. But we used that because that was what the market was thinking, and we used that as the rates we used in estimating prices and things.
Nowadays, right? So if you were to tell somebody, I learned this while working here, and this is how it relates to everything I do till now being a professor, what could you say that is?
Well, I learned a lot about trading and about packaging mortgages and about details. I knew a lot about mortgages going in, which is presumably why they hired me. But I learned a lot. I hadn't really worked for a business before. I had worked for the government and I'd been an academic. And that was an interesting experience because, you won battles, you lost battles. And I learned a lot about that.
To keep on fighting those battles.
Well, yeah, they get resolved eventually, but yeah.
Yeah, but that's really interesting. And you also told me that you've written a book with your with a co-author.
With a co-author,
yeah.
And it's this one.
Yes.
Self-promotion here.
Yes.
It's called When Housing Markets Meet Shadow Banking. And what it is basically is a history since about 1990 of mortgage markets, how they affect housing, and how the mortgage market has developed. My co-author is Chinese, and so one of the things we've done is compare what happened in the U.S. Side by side with China, and looked at how the different institutions evolved over time. And as you might expect, there were similarities, but there were a lot of differences.
Differences because of the system or because of reg?
Shadow banking in the U.S. has really been around for a while, and it's really institutions that look like banks and operate like banks but don't have bank charters and don't have the protections that banks have from deposit insurance. So shadow banks evolved outside of that. What could they do that the system as it was couldn't do? Mm-hmm. And so they did banking in niches that they found, and that's been common all over the world. Yeah. In the U.S., a lot of it was Wall Street, in the sense that Wall Street would create portfolios and things that looked like banks and held long-term securities, the assets, and issued short-term liabilities. So they operated a lot like banks. But unlike the banks, mostly, they could collapse easily. Banks have deposit insurance, and they don't collapse. And these were a big part of what happened. In China, the difference is a little bit different because mortgage markets had to evolve outside of the Chinese banking system. The big banks in China, and there are 4 colossal ones, don't really do much in terms of mortgages, at least in the terms of home ownership. So the shadow banks evolved. They're a big and well-known part of the system, They make loans, real estate and real estate development, and ultimately mortgages. But they're different. Unlike the U.S., they tended not to be short-term funds a lot. And unlike the U.S., they didn't securitize.
Oh.
And that was an issue in the U.S. I think that's part of what made the mortgage work well. What they did do was make loans. What they did do was issue various sorts of savings and investment products that weren't really deposits. They had some things that were like deposits, but they weren't as sensitive as the shadow banking system in the U.S. to changes in interest rate. So one of the things that seems to have had happened is the U.S. really did have a bubble with house prices, and it really did have a crash, and it really did have panics in, to some extent, this system of shadow banks. It really did have house prices go down. There really was a bubble. In China, house prices grew very rapidly, but they don't seem to have crashed, at least not like in the U.S. So it looks like in China, a large part of what was happening was that house prices were chasing rents, which is a measure of the value of space.
Okay.
And in the U.S., house prices were chasing house prices.
Oh, okay.
And that was a big difference.
Yeah, that's a big difference because the final consumer in China was not as affected as the U.S.
No. And it wasn't much affected by the collapse in the West. China's banking system really doesn't operate much outside of China.
Yeah. Oh, yeah, that is so true because when the crisis of 2008 happened, it affected every other country that relies in the U.S. actually, like even countries from the Latin American section. I'm actually from one of them, so I kind of heard some stories like how it happened, and it was all like really bad.
So there were house price declines in a lot of places, especially in Europe, especially in England. They didn't have a lot of securitization, but they did have a lot of bank lending. And some of that crashed. I mean, and it was for other reasons as well. The banks crashed a little bit later than mortgage banks in the U.S.
Okay.
But they were there.
They were there. Yes, that is right. You've been working in finance since before the crises that have happened, whether it's 2008, 2020, and now we're in 2025. But do you see any modern business model that kind of looks alike or gives you some red flags that you used to see before?
Well, a lot of it is things that are new and things where assets have bubbles, where they increase too rapidly to be sustained. That happened in the U.S. along with a lot of other things. And a lot of new products had bells and whistles that the market didn't particularly understand. The market was maybe a little too optimistic about house price growth at a time when they'd probably grown too fast. And so that's a big part of it. I don't particularly see that right now. From the standpoint of risks in the economy, what I think is the big issue is political risk. There are big political battles over things like the Fed and all sorts of other institutions. And that could have effect. It's not showing up right now, but it could have.
And actually, you reminded me of something that when you said that people don't have enough information about the specific asset that's creating a bubble. And people are now talking about AI. And AI now even relates to the government because there are huge companies who rely on AI and also systems that are just merging technically with the government, whether it's chip makers or cloud makers such as Oracle, or we're talking about Intel, Oracle, and other companies. And we see how these are, they have more information than the rest of the population.
That's right, and they can process it faster. And they can do all sorts of interesting things. For instance, getting back to my book, I went to AI on Google and asked it to write a critical analysis of the book, and they did. I'm not going to say what they said, but it was interesting, and my co-author and I both thought it was mostly on point. So it's a very flexible tool, and I think the problem with it is not so much about technology per se. That can be adjusted to, but not very quickly. And so it's possible that there will be, maybe not right now, but that there will be an issue with what happens to all these people that get displaced because of AI. Where will they go? Will they be able to buy the stuff that the AI produces?
Exactly.
And what can the government do to smooth it out?
Yeah, that is so true. Actually, I have a part-time job, and in my part-time job, I do some reports, and I'm like, but what if AI one day takes over my job? Like literally, it's some months away from taking it from me.
Yeah, it could be. And you know, my co-author and I have talked about what if AI had been around when we were writing the book. And the answer is it would have been a really great tool as a research assistant. We have a long bibliography and a lot of references. And we could certainly have spent a lot less time on that than we did. I don't know that AI could have written the book. I guess I'm too arrogant to think that. But you could think of AI as a really, really powerful research assistant.
Research assistant.
Yeah.
That is.
And writing first drafts or things like that.
Yeah, that could be, yes. And also, I mean, AI is a tool that you can use, but also it can also slow your mind, I would say, not rely fully on it.
That is an issue. And you know, it's an issue with students. I'm a professor. I have had occasions where I'm sure students used AI. I'm not giving any papers this semester, so that won't happen. But yeah, that's troublesome. Now that's not new. Students wrote papers that they manufactured from other papers, but this is a big deal. And as academics and as teachers, we want them to be able to use this tool. It's a really neat tool. On the other hand, you know, there are limits.
There are limits to it, right? That is true. And you've been a professor, and also you work with people in the DMV area in public schools. You told me something about this.
So we have a startup that I'm pleased about. And what we've done, it took a couple of years to get it going. But one of the things I and my partners thought about in the summer of 2020, which was an interesting summer, you know, what could we do that was more like what we're good at? And you know, one of the things we came across was, you know, education. And so what we did, and this is run by the finance department, what we did was partner with a DC public school. We talked to them a few times, but they sent some students over, and there were maybe 13 of them, and we gave them something like an introductory college course. What we really wanted to do was partly to sell the idea of college, but get their fingers dirty looking at the data. And the neat thing about it, which wasn't my influence, but was particularly with Rodney Young, who you know, and his people, they had a really neat project where they had to look at companies, or a company, and look at it and summarize it, look at the data, and then give a presentation. And this was very different for a lot of them. We had a 3-panel judge, I was one of them, who made comments about them and asked questions while they were presenting. And it worked very well. The students did a good job. Some were nervous and went through it anyway. Some went through it like they've been doing this all their life. But it gave a sense of this is something you can do and get into. And I know we're going to try it again next year.
Because that spikes teenagers' interest for.
Yeah, these are likely to be juniors.
Oh, okay.
Between their junior and senior year.
Yeah.
If they're seniors, graduating seniors, it doesn't help much. So they'll probably be juniors, maybe even students between sophomore and junior year. But this year, I think they were mostly juniors.
Oh, nice. That is so interesting, because if I ever had that tool when I was a junior or a senior, and I knew that this could have been done within finance, I would have taken such advantage of it. Yeah.
I mean, you know, one of the things that's happened with data is students can do this stuff. They can write reports. They can use the data and run it. And, you know, like my daughter is way better at running the computer and pushing things out than I am. And so it's, you know, it's something that they can feel like they've accomplished something. And they all presented a report. And they all had different industries, all different companies. And it was nice.
That is so great. Are you going to do that this summer?
I certainly hope so. It was successful. It was self-funded. It was by donations from people who were interested in it. So mainly what the university provided was space, And, some of the faculty and people in Professor Lake's group worked on it.
Yeah.
But one of the things we did was give a stipend to the students in lieu of them working. And it didn't cost that much. It was easy to run. We have funds left over. I hope we could maybe partner with a second school, but that we have to see.
We'll have to see, yeah. Some interesting high school out there. Well, that is so interesting. And I really hope that, if somebody was to read your book, again, we're going back to the book, what would you like for them to get out of it? Like just one single thought.
Well, it's sort of history, but there are sort of two dimensions to it, a horizontal one and a vertical one. The horizontal one looks at both countries through time and what happened to property values and things like that. The horizontal one looks at the differences between China and the U.S. So the horizontal one is in many ways more interesting, getting a sense of what shadow banks are like in different countries, getting a sense of what securitization is like, particularly in the U.S. So I don't have a simple answer, but that's what we intended to look at.
Okay, that is so great. And nowadays, before we wrap up, is there some news that you've been listening to or that have caught your attention?
Well, the same news that's caught everybody else's attention. We have the curse of living in interesting times. I don't know that the economic consequences are huge. I think, as I said, there's political risk. I don't know if we'll have a recession, but there are risks in terms of policy, in terms of tariffs. But I think they are dwarfed by some of the other risks that we have.
So many risks. And latest news, having these budget cuts of around $26 billion, whether for infrastructures or for government funding, it's just going to have a huge ripple effect through the entire country. And
this has consequences that are above my pay level in terms of pay grade, in terms of the Constitution and what presidents can do.
Exactly.
And all that.
That's so crazy. But we'll have to see what happens. And it's so great
we
to have...
We will have to.
Yeah. Yeah. And it's so great having professors like you that actually talk about what trends we could look at every day in order to draw our conclusions. Yeah. But it was so nice having you today.
It was very nice to be here. Thank you.
Yes, thank you so much. And we will leave the link for your book and also the project you currently work on.
Yeah, and there's a link from an article in GW today about the summer project.
Okay.
So people can look it up.
Yes, they should look it up because that's really interesting.
Whether they should or not, I'm not sure, but they certainly can.
That is really good. Thank you so much for all your work. And thank you for everybody listening. We really appreciate your time, and we'll see you next week.
Okay.
Yeah.